very wealthy individuals and families in the Middle East and in Asia in particular, but also in Europe, have been buying gold as protection. I think we all know that the main driver of gold for the last 2 years has been central banks in an effort to diversify away from dollars in their reserves in the face of dollar weaponization. So we all know that's been the driver. And of course, the central banks that have been buying gold, and as you mentioned, last year was another record high. December was very, very strong. So it seems to be accelerating, there's no pause. People were thinking there'd be a pause. But that has nothing to do with the strength of the dollar or the strength of the U.S. economy or whether interest rates are positive or negative on a real basis in the U.S. Or the jobs market or anything else. It has nothing to do with what's happening in the U.S. The sort of traditional drivers of gold, if you like, the macroeconomic drivers of gold is not what's been driving gold this time. And it's not just central banks, of course. Beginning of last year, we saw a big spike in Chinese consumer buying of gold in the face of a declining economy or fears of a declining economy in China. Yuan depreciation, and of course concerns about the fragility of the banking system. So Chinese consumers moved into gold. But again, that has nothing to do with what I'll call the traditional macroeconomic drivers of gold.
Right. Yeah. Well, with this rise, I mean, talk to me about the untraditional movements and why it's taking place, but also how sustainable is it? We all seem to be waiting for this $3,000 level.
Well, to be honest with you, I've been thinking that we'd get a pause in this. Gold has been remarkably resilient. We did see that bit of a decline when it looked like, when Trump was elected, President Trump was elected. It started, at the end of October, right before the election. So we saw a little bit of a decline. I honestly thought it was going to be a bit of a longer and deeper decline. But to me, it just shows that there is an awful lot of pent-up demand among central banks. I mentioned the Chinese, and also, of course, very wealthy individuals and families in the Middle East and in Asia in particular, but also in Europe, have been buying gold as protection against, let's say, the fragility of the financial system. With record debt everywhere you look, both at the government level and in many countries at the household level. The debt levels among governments are frankly unsustainable. And so I think people are buying gold as a protection against that. You alluded to it at the beginning, and I think, we'll get to it, I'm sure. But the one source of demand that isn't there right now is what I'll call ordinary retail investing in North America. That's just not in the market right now.
Yeah, it's been fascinating to watch. We're all wondering when those investors will get in. We'll break that open for a second, but let's go back there for a second because we brought up, this demand from the central bank, and we also are seeing this new story about gold leasing rates in London. They've surged 10 to 12% due to tightness in market, and the U.S. is, of course, hoarding the bullion, and we're also seeing gold pouring in from the U.S. from major Asian market hubs like Dubai and Hong Kong as global bullion banks rush to capitalize, obviously, on these unusually high premiums of U.S. gold futures. Now, for the audience, traditionally gold flows eastward to meet demand from China and India, the world's two largest consumers, accounting for nearly half of the global demand. But that seems to be changing here. I mean, there's concerns over U.S. import tariffs proposed by Trump. They've pushed COMEX futures high enough that, well above the spot price. Break down this arbitrage opportunity. What are we seeing here? How can we capitalize on it?
Yeah, I'm not sure that we as individuals can capitalize on it, but my own feeling is that this is an interesting, certainly a very interesting story, but I think people are maybe making too much out of it. I don't think it's the beginning of the end of anything, or the end of the beginning of anything, frankly. You had people, logically, you had U.S. people move gold from holdings in London via Switzerland, because bars have to be refined to move to the U.S. You had people moving gold to the U.S. ahead of tariffs, because, of course, if tariffs were imposed on Europe and the U.K., even 10%, nobody wanted to buy gold or import their gold when it's 10%, so people were moving ahead of that. And of course, as you mentioned, that's led to this divergence in prices. We've got a premium in US prices as much as $30 at one point, and a dollar an ounce on silver at one point, and we're now getting a discount in London, right? So there is an arbitrage opportunity. But you know what happens with arbitrages normally? They work themselves out, as more and more people take advantage of that arbitrage. And just as we saw this move from London to the US during COVID, when people were afraid they simply wouldn't be able to ship gold, and now it's for other reasons, but they wouldn't be able, that unwound once the COVID panic was over. And I think this is going to unwind at some point once the tariff panic, if you like, is over.
Yeah, that makes sense. I mean, we still have a month of it. It's that we got this month of uncertainty here when it comes to tariffs. Any idea as to, I mean, we don't have you and I talked, Adrian, the news is going so quick that we're not sure if we can even cover it all. But, what does this next month of uncertainty mean for the gold market?
I think it's going to mean the gold price is going to stay high. I mean, there's a lot of drivers, and tariffs just one of them. Tariffs are just one of them. So I think the gold price is going to stay high. The demand is remarkable. And as we mentioned, the regular North American investor, and by regular, I mean retail, I mean small institutions, I mean generalist funds, they're not simply in the gold market right now. They're not in the market at all. If you look at the GLD, which is the largest, the largest physical gold ETF in the US, one day in January had net inflows. Just one day had net inflows. We're going to talk about stocks later, but maybe I'll give you the, don't bury the lead. I'll give you the lead right now. The GDX and the GDXJ had 0 days of net inflows in January. I mean, this is astonishing. When the gold stocks are up 47% in the last year, and the major gold equity ETFs are not seeing inflows. Same goes for gold mutual funds, I can tell you. The ordinary investor is not only are they not moving into gold, they're continuing to sell gold and gold stocks.
Yeah.
For gold.
Yeah, I told her coming on the show here, Adrian, and they were asking me on X to get your gold outlook. So I have to ask you about prices. I mean, break down short-term targets, long-term targets. I know we got that psychological level of $3,000 gold, but we're damn near there.
We're almost there. It's funny. Just in Vancouver, you mentioned Vancouver 2 weeks ago, someone said, so give me a target for gold this year. Do you think we'll break through 3,000? I said, that's not a very aggressive target right now. To me, the price itself, and I'm not avoiding the question, the price itself is far less important than direction. And the direction to me over 6 months, 12 months, 24 months is definitely up. So who was it? Someone, I forget who, said, if you want to know what the gold price is going to do, tell me what the dollar's going to do. And gold is moving up in the face of a strong dollar. So when the dollar turns, if the dollar turns, then gold could move just dramatically higher in terms of US prices. I don't know. I wouldn't be surprised at all to see, we might get some backwards and forwards at the 3,000 level. We often do. But the way gold is moving right now, I think we could easily just break right through it. And remember, if most of your buyers are non-US people, right, they're looking at gold priced in Australian dollars or Chinese yuan or Japanese yen. They're looking at gold in their own currency terms. And so 3,000 is not a magic number for them. So I wouldn't be at all surprised to see 3,500 to 4,000, that kind of range, within the next 12 months.
Yeah, fascinating. Well, we'll watch for it. I got to ask you before we let you go here. I mean, markets are focused on inflation, the Fed. We're talking about some of these issues with tariffs, but what's the biggest geopolitical or financial risk that investors aren't pricing in here? I mean, there seems to be some underpriced risks right now.
Gosh, I wish you'd asked me the thought about it. I mean, I think certainly the high debt levels are something that certain people are beginning to really look at because they're unsustainable, frankly. They are not just in the US, but in Certainly in most of the major economies around the world, debt levels are simply unsustainable. And so that means something's going to break, something's going to change. That certainly is a big risk. Yeah.
Debasement. I wonder what'll take, when you talk about Trump with these 100% tariffs on BRICS countries and stuff, I wonder who's going to, front run this. Who's going to win?
The problem is with tariffs, nobody wins. Nobody wins. The consumer always loses, because the truth is we produce things as individuals and as countries that we have special skills at, and we exchange them for things that other people produce that they have special skills at. And that's what makes that's what makes a global economy grow. So in a trade war, nobody wins.
Yeah, nobody wins. Okay, well, we're going to watch the environment, maybe $3,400, $4,000 gold. Adrian Day is the CEO of Adrian Day Asset Management. Thanks for joining us today, my friend. Appreciate your time.
Well, thank you very much, Jeremy. It was interesting. It was fun.
Yeah, looking forward to the next one. Thanks, Adrian.